Title: Genius Act and the New East India Company, How the U.S. Dollar Stablecoin Challenges the Existing Legal Currency System and National Form. Date: July 19, 2025. Introduction. The financial landscape is undergoing a seismic shift with the introduction of the Genius Act and the rising prominence of U.S. dollar stablecoins. This report elucidates the implications of these developments for the global currency system, examining how stablecoins are positioned to challenge traditional forms of legal currency and national monetary systems. The rise of stablecoins. Stablecoins, particularly those pegged to the US dollar, are gaining traction in various financial ecosystems, especially for cross-border payments. As of mid-2025, companies like PayPal and MoneyGram are leveraging stablecoins to facilitate remittance services, reducing transaction costs significantly. Reports suggest that the use of stablecoins can lower fees from over 6% to mere basis points, while settlements that traditionally take days can now be completed in minutes. Impact on cross-border payments. One of the most significant use cases for stablecoins lies in cross-border transactions. As highlighted in the FXC Intelligence Report, stablecoins represent a transformative technology in payments, facilitating faster, cheaper, and more efficient transactions. The rapid growth and adoption of this technology are indicative of a broader acceptance of digital currencies in mainstream financial operations. Operational advantages. Stablecoins provide operational efficiencies that traditional financial systems lack. They enable real-time liquidity management and offer programmability features that streamline cash flow operations. For instance, businesses can automate their treasury functions, effectively managing their liquidity without relying on slow, cumbersome banking processes. The Genius Act, a regulatory framework. The proposed Genius Act aims to establish a comprehensive regulatory framework for stablecoins, ensuring issuer accountability, reserve requirements, and consumer protections. While the legislation has faced procedural hurdles in Congress, its passage is seen as critical for the mainstream adoption of stablecoins. President Trump has been an ardent supporter of the bill, emphasizing the need for the U.S. to lead in the crypto space. Legislative journey. The journey of the Genius Act began with the initial discussions in 2023, gradually gaining momentum as the implications of stablecoins became more apparent. However, by July 2025, the act faced political complexities, with bipartisan disagreements delaying its progress. Despite these challenges, the urgency for regulatory clarity has prompted renewed efforts to advance the legislation. Challenges ahead. Despite the promising outlook for stablecoins, several challenges persist. Regulatory uncertainty remains a significant barrier to widespread adoption. The interaction between traditional finance and the emerging crypto landscape necessitates a clear framework that addresses compliance, anti-money laundering, AML measures, and consumer protections. Market dynamics and institutional adoption. As stablecoins continue to evolve, their integration into traditional financial systems is becoming increasingly apparent. Financial institutions, payment service providers, PSPs, and corporate treasuries are beginning to adopt stablecoins for various applications, including B2B transactions, payroll, and treasury management. Global regulatory landscape. The regulatory landscape for stablecoins is rapidly evolving, with jurisdictions worldwide working to establish clear guidelines. In the United States, the Genius Act represents a potential turning point, while the European Union's markets in crypto assets MiCA regulation provides a comprehensive framework for stablecoin issuers. Other regions such as Asia and the Middle East are also developing their regulatory standards, creating a diverse and complex environment for stablecoin operations. The future of stablecoins. The trajectory of stablecoins suggests a future where they play a central role in modern financial infrastructure. Their ability to provide fast, cost-effective, and programmable payment solutions positions them as viable alternatives to traditional currencies. As regulatory clarity improves and institutional adoption grows, stablecoins could redefine the nature of money and payment systems. Conclusion: the Genius Act and the rise of US dollar stablecoins signify a pivotal moment in the evolution of global finance. By challenging the traditional legal currency system and national forms of money, stablecoins are poised to reshape the financial landscape, offering enhanced efficiency, reduced costs, and improved accessibility. The path forward hinges on the successful navigation of regulatory challenges and the establishment of a coherent framework that fosters innovation while ensuring consumer protection. As we advance, the implications of these developments will resonate across economies, potentially leading to a new era of digital finance. The emergence of stablecoins, particularly US dollar stablecoins, alongside regulatory initiatives like the Genius Act, is set to disrupt the traditional currency systems worldwide. This transformation is more profound than it may initially appear, and several counterintuitive aspects are worth highlighting. Counterintuitive aspects of stablecoins and the Genius Act. 1. Stablecoins as a threat to national sovereignty. While stablecoins are often viewed as a technological advancement that enhances financial efficiency, they also pose a threat to national monetary control. The ability of stablecoins to facilitate cross-border transactions without the need for traditional banking intermediaries could diminish the power of national currencies. Governments may struggle to maintain monetary policy effectiveness if stablecoins become widely adopted, leading to questions about the future role of central banks. 2. Regulatory backing may enhance adoption. The Genius Act aims to provide a regulatory framework for stablecoins, which many might assume would stifle innovation. However, this structured oversight could actually bolster consumer and institutional confidence in stablecoins, accelerating their adoption rather than hindering it. The clarity provided by regulation can reduce fears of fraud and instability, making businesses more willing to integrate stablecoin solutions into their operations. 3. Lower transaction costs yet higher initial barriers. Though stablecoins promise significantly reduced transaction costs in cross-border payments, from over 6% to mere basis points, the initial integration costs for businesses may be high. Companies might need to invest in new technologies and compliance measures to adopt stablecoin infrastructure. This paradox means that while stablecoins could eventually save money, the upfront investment required could be a barrier for many organizations. 4. Programmability as a double-edged sword. The programmability of stablecoins, allowing for automated transactions and smart contracts, is often touted as a major advantage. However, this feature can also introduce complexities and vulnerabilities that traditional payment systems do not face. If smart contracts are poorly designed or contain bugs, it could lead to significant financial losses or exploitation by malicious actors. Thus, while programmability offers enhanced functionality, it also necessitates a higher level of vigilance regarding security and operational integrity. 5. Increased financial inclusion or new forms of exclusion. Stablecoins have the potential to increase financial inclusion by providing access to financial services for unbanked populations. However, the reliance on digital wallets and internet access could paradoxically create new forms of exclusion. Those without technological literacy or access to the internet may find themselves further marginalized as financial services shift to digital-first models. 6. US dollar dominance at risk from dollar stablecoins. While it may seem counterintuitive, the proliferation of US dollar stablecoins could inadvertently weaken the dominance of the dollar itself. As stablecoins provide an alternative means of conducting transactions globally, their use could encourage countries to explore alternatives to the dollar for international trade. This scenario could lead to a diversification of currency reserves and transactions away from the dollar, challenging its status as the world's primary reserve currency. 7. Innovation stifled by overregulation. The Genius Act and similar regulatory frameworks are designed to create a safe environment for stablecoin usage. However, there is a risk that overly stringent regulations could stifle innovation in the space. Startups and smaller firms which often drive innovation may lack the resources to comply with extensive regulations, leading to a market dominated by a few large players. This concentration could hinder the diversity of solutions available and reduce competitive pressures that drive technological advancement. 8. Perception of stability versus actual stability. The very name stablecoin suggests a level of stability that may not always be guaranteed. While these coins are pegged to fiat currencies like the US dollar, their stability can be compromised by various factors including market sentiment, regulation changes, or issuer failures. Thus, while they serve as a more stable alternative to volatile cryptocurrencies, their perceived stability may lead users to underestimate the risks involved. 9. Interoperability challenges. The growing number of stablecoins could lead to fragmentation in the ecosystem, making interoperability a challenge. Users may find it difficult to convert between different stablecoins or integrate them into existing financial systems. This fragmentation contradicts the initial goal of stablecoins to simplify transactions and could complicate the user experience, deterring adoption. 10. Environmental impact of stablecoin infrastructure. The infrastructure supporting stablecoins, particularly if based on proof-of-work blockchains, could contribute to environmental concerns due to high energy consumption. While stablecoins are often positioned as a progressive financial innovation, their reliance on energy-intensive technologies may counteract claims of sustainability, leading to a backlash against their adoption. Conclusion. The rise of US dollar stablecoins and regulatory initiatives like the Genius Act signify a pivotal shift in the global financial landscape. While these developments promise numerous efficiencies and innovations, they also present complex challenges that may not be immediately apparent. Understanding these counterintuitive aspects is crucial for stakeholders as they navigate the evolving landscape of digital currencies and stablecoin integration into traditional financial systems. As the regulatory environment matures, the implications for currency sovereignty, market dynamics, and financial inclusion will continue to unfold, revealing both opportunities and risks for all participants in the financial ecosystem. Key overlooked aspects of the Genius Act and US dollar stablecoins. The emergence of US dollar stablecoins and the proposed Genius Act could significantly alter the landscape of global finance, yet certain critical elements within the discourse are often glossed over or inadequately explored. Here are the most significant aspects that deserve greater attention and why they matter. 1. Regulatory framework and its implications. While the Genius Act is frequently discussed in terms of its potential to regulate stablecoins and ensure issuer accountability, the broader implications of such a regulatory framework are often overlooked. The Genius Act aims to create a clear regulatory environment for stablecoin issuers, but this clarity may also impose stringent requirements that could stifle innovation. Significance. A well-defined regulatory framework can improve consumer trust in institutional adoption of stablecoins, but overly strict regulations may deter new entrants and limit the diversity of stablecoin offerings. The balance between fostering innovation and ensuring safety is delicate. Excessive regulation could hinder the rapid evolution of financial technologies that stablecoins enable. 2. Impact on traditional banking systems. The rise of stablecoins poses a fundamental challenge to traditional banking systems, particularly concerning their role in cross-border payments and liquidity management. While reports highlight the potential for stablecoins to reduce transaction costs and increase speed, the implications for banks' roles as intermediaries in financial transactions are less frequently discussed. Significance. Should stablecoins achieve widespread adoption, banks may face diminished relevance in their traditional roles, leading to potential job losses and a re-evaluation of their business models. This shift could catalyze a broader transformation in the financial sector, compelling banks to innovate and adapt rather than maintain the status quo. 3. Political dynamics surrounding the Genius Act. The political intricacies affecting the passage of the Genius Act are often downplayed. The Act's progress is hindered by bipartisan disagreements and procedural challenges. as evidenced by the recent stalling in the House of Representatives. Trump's attempts to rally support highlight the political maneuvering involved in crypto legislation. Significance: understanding the political landscape is crucial for anticipating the future trajectory of stablecoins and related technologies. The outcome of the Genius Act will not only impact the regulatory framework for stablecoins but also reflect broader societal attitudes toward cryptocurrency and innovation in finance. The political resistance may also indicate a lack of consensus on the role of digital currencies in the economy. 4. Consumer protection and financial inclusion. While the potential of stablecoins to enhance financial inclusion is often mentioned, the nuances of how these digital assets can protect consumers and enhance access to financial services are frequently overlooked. The regulatory measures proposed in the Genius Act could include consumer protection mechanisms that are essential for fostering trust in stablecoins. Significance: stablecoins hold the promise of providing financial services to the unbanked and underbanked populations globally. However, without robust consumer protection measures, there is a risk that these populations could be exploited or face losses due to volatility or fraud. Ensuring that the regulatory framework includes provisions for consumer education and protection will be vital for sustainable adoption. 5. Technological infrastructure and integration challenges. The technological complexities involved in integrating stablecoins into existing financial systems are often underestimated. The transition from traditional banking rails to stablecoin infrastructure requires significant investments in technology compliance and operational readiness. Significance: the success of stablecoins depends on their seamless integration into existing financial systems. If firms cannot adapt their infrastructure to accommodate stablecoins, the anticipated benefits of speed and cost reduction may not materialize. Companies that proactively address these challenges will likely emerge as leaders in the evolving financial landscape. 6. Global competition and geopolitical factors. As US dollar stablecoins gain traction, the geopolitical implications of their adoption are frequently overlooked. Countries with unstable currencies may increasingly turn to stablecoins as a means of preserving value, which could have ramifications on global financial stability and US dollar dominance. Significance: the rise of stablecoins could lead to a shift in power dynamics in international finance. If other nations develop their stablecoins or digital currencies, it could challenge the US dollar's status as the world's primary reserve currency. The geopolitical tension surrounding currency dominance may become a critical area of focus for policymakers and financial institutions alike. 7. Environmental impact of stablecoin technology. The environmental implications of blockchain technology, particularly in relation to stablecoins, are often overlooked in discussions of their benefits. The energy consumption associated with maintaining blockchain networks, especially those that use proof-of-work mechanisms, raises questions about the sustainability of stablecoins. Significance: as concerns about climate change intensify, the environmental footprint of stablecoins could impact their acceptance and regulatory treatment. Innovations aimed at addressing these concerns, such as transitioning to more energy-efficient consensus mechanisms, could become a focal point for the industry, influencing both public perception and regulatory scrutiny. Conclusion: the discourse surrounding the Genius Act and US dollar stablecoins often simplifies complex issues into binary narratives of innovation versus regulation. However, a deeper examination reveals a myriad of factors that could profoundly influence the future of finance. Understanding these nuances is essential for stakeholders across the financial ecosystem, including policymakers, businesses, and consumers, as they navigate the evolving landscape of digital currencies and stablecoins. Key points for analysis and discussion. 1. Impact of stablecoins on cross-border payments. Stablecoins are revolutionizing the landscape of cross-border payments by reducing transaction costs and settlement times. Traditional systems often incur fees exceeding 6%, while stablecoin transactions can reduce costs to mere basis points. Reports highlight that stablecoins enable settlements in minutes rather than days, allowing for real-time liquidity management and streamlined operations for businesses. The growing adoption of stablecoins by major companies like PayPal and MoneyGram underscores their potential to facilitate faster, cheaper, and more efficient remittances and international payments. This shift challenges traditional banking models and calls for a re-evaluation of how financial transactions are conducted globally. 2. Regulatory framework and the Genius Act. The proposed Genius Act aims to establish a comprehensive regulatory framework for stablecoins addressing concerns about issuer accountability, reserve management, and consumer protection. As the regulatory landscape evolves, the Act could play a pivotal role in determining how stablecoins are integrated into the existing financial system. The need for clarity and consistency in regulations is crucial as it affects institutional trust and the broader acceptance of stablecoins. The legislative process surrounding the Genius Act is fraught with political complexities, highlighting the challenges of achieving bipartisan support for cryptocurrency regulation in the U.S. This context provides a critical avenue for discussion about the implications of regulatory uncertainty on innovation and adoption in the crypto space. 3. Technological integration and operational challenges. The integration of stablecoins into existing payment infrastructures presents operational challenges, including compliance with anti-money laundering (AML) and Know Your Customer (KYC) regulations. Payment firms must navigate the complexities of blockchain technology, including the management of digital wallets, transaction monitoring, and smart contract risks. Despite the advantages of stablecoins, such as programmability and transparency, firms face significant hurdles in ensuring compliance and operational resilience. This discussion point can lead to an exploration of best practices for integrating stablecoins into financial systems, as well as the technological advancements needed to mitigate risks. 4. Transformative potential of stablecoins in the financial ecosystem. The rise of stablecoins signifies a broader transformation in the financial ecosystem, moving from traditional fiat systems to a more digitized and programmable monetary framework. As stablecoins gain traction, they challenge the supremacy of existing legal currencies and national forms of money. The discussion can delve into how this evolution might impact monetary policy, central bank digital currencies (CBDCs), and the overall structure of global finance. Furthermore, the implications for financial inclusion, particularly in regions with limited banking access, present a compelling narrative about the democratizing potential of stablecoins as a financial tool for underserved populations. These 4 points collectively encapsulate the multifaceted nature of the ongoing transformation in the financial landscape driven by stablecoins and regulatory developments, particularly the Genius Act. Each point offers a rich foundation for in-depth analysis and discussion on the future of money payment systems and regulatory frameworks in a rapidly changing digital economy. Here are 3 famous historical cases that bear resemblance to the themes surrounding the Genius Act and the emergence of U.S. dollar stablecoins, particularly in terms of financial innovation disrupting existing systems and regulatory responses. 1. The establishment of the First Bank of the United States, 1791. The First Bank of the United States was created to stabilize and improve the nation's credit and to improve the handling of the financial business of the U.S. government under the newly enacted Constitution. It represented the federal government's first attempt to create a centralized banking system, which faced significant opposition from those who feared that it would undermine state banks and lead to excessive federal control over financial matters. This scenario is analogous to the current debate on stablecoins and digital currencies, where traditional financial systems are challenged by innovative technologies. The establishment of the bank highlighted the tension between innovation in finance and regulatory oversight, much like the current discussions surrounding the regulation of stablecoins under the proposed Genius Act. 2. The gold standard and the rise of fiat currency, 19th to 20th century. The transition from the gold standard to fiat currency in the 20th century was marked by significant economic changes and debates over monetary policy. Central banks, including the Federal Reserve in the U.S., evolved to manage monetary systems that were no longer tied to physical commodities. This shift allowed for greater flexibility in monetary policy but also led to concerns regarding inflation and the stability of currency. The emergence of dollar-backed stablecoins parallels this historical transition as they represent a modern attempt to create a stable form of currency that can operate digitally while being pegged to traditional fiat currencies. The regulatory frameworks being discussed today echo the debates of the past regarding how best to manage currency stability and trust in monetary systems. 3. The Panic of 1837 and the role of state banks. The Panic of 1837 was a major economic crisis in the United States that resulted from a combination of speculative land deals, the failure of banks, and the collapse of the cotton market. During this period, state-chartered banks operated with varying degrees of regulation and oversight, leading to widespread distrust in bank runs. The crisis ultimately highlighted the need for a more unified and regulated banking system, which paved the way for future reforms in the financial sector. The current emergence of stablecoins, particularly in the context of the Genius Act, reflects a similar concern about the stability and security of new financial instruments and the necessity for regulatory frameworks to prevent systemic risks. The historical lessons from the Panic of 1837 illustrate the potential consequences of unregulated financial innovation, resonating with contemporary discussions on the need for robust regulation of digital currencies. The Genius Act and the rise of U.S. dollar stablecoins are set to significantly reshape the future of the financial landscape, presenting both challenges and opportunities for the existing legal currency system and national forms of money. As we look toward 2025 and beyond, several predictions can be made about the implications of these developments. 1. Increased adoption of stablecoins. By mid-2025, the adoption of U.S. dollar stablecoins, like USDC and USDT, will likely escalate, spurred by their integration into existing payment infrastructures. Businesses and consumers will increasingly choose stablecoins for cross-border payments due to their ability to reduce transaction costs and settlement times dramatically. The reports indicate a shift from traditional financial systems where remittance costs often exceed 6% to a model where these costs are reduced to mere basis points. 2. Regulatory frameworks solidifying. The passage of the Genius Act is anticipated to provide a clearer regulatory framework for stablecoins, enhancing issuer accountability and operational stability. This legislation will likely establish guidelines that promote transparency in reserve management and consumer protection, paving the way for broader institutional adoption. As confidence in the regulatory environment grows, more businesses will integrate stablecoins into their treasury management and payment systems. 3. Transformation of payment systems. Stablecoins are expected to revolutionize the payment landscape, offering faster, programmable, and more transparent alternatives to traditional currency systems. Their inherent advantages, such as instant settlements and lower fees, will drive adoption in sectors ranging from retail to corporate treasury management. As major payment service providers like Visa and MasterCard enhance their systems to incorporate stablecoin capabilities, the distinction between crypto and traditional payment rails will blur, leading to a more integrated financial ecosystem. 4. Global monetary dynamics shifting. As stablecoins gain traction, they will pose a challenge to the supremacy of existing fiat currencies. Countries with unstable currencies may see increased adoption of U.S. dollar stablecoins, providing a safe haven for individuals and businesses. This trend could lead to a re-evaluation of local currencies' roles, potentially fueling discussions around de-dollarization in various regions. The implications for central banks and monetary policy will be profound as they grapple with the influence of decentralized financial systems. 5. Emergence of new financial products. The programmability of stablecoins is expected to spur the creation of innovative financial products and services. Financial institutions will likely develop new offerings around automated treasury operations, escrow services, and milestone-based disbursements. This will not only enhance operational efficiencies but also provide businesses with more flexible financial tools that adapt to the fast-paced digital economy. 6. Challenges in integration and compliance. Despite the advantages, the integration of stablecoins into existing financial systems will not be without challenges. Firms will need to navigate complex regulatory landscapes ensuring compliance with anti-money laundering (AML) and Know Your Customer (KYC) requirements. The operational risks associated with blockchain technology such as smart contract vulnerabilities and custody issues will require robust frameworks and insurance mechanisms to protect users and institutions alike. 7. Rise of institutional interest. As regulatory clarity improves, institutional interest in stablecoins will likely rise. Financial institutions and corporate treasuries will seek to leverage stablecoins for liquidity management, cross-border transactions, and real-time settlements. The growing acceptance of stablecoins by established banks and payment processors will further solidify their role in mainstream finance, providing a bridge between traditional and digital finance. 8. Impact on financial inclusion. Stablecoins may play a crucial role in enhancing financial inclusion, particularly in regions with limited access to banking services. By facilitating instant low-cost transactions, stablecoins can empower unbanked populations, enabling them to participate in the global economy. Initiatives leveraging stablecoins for remittances and microtransactions will likely emerge, contributing to economic development in underserved areas. Conclusion. The convergence of the Genius Act and the rise of US dollar stablecoins heralds a transformative era for the global financial system. As these digital assets gain traction, they will challenge the existing legal currency frameworks and national forms of money, leading to a more dynamic, efficient, and inclusive financial landscape. The next few years will be critical in shaping how these changes unfold, with regulatory clarity, institutional participation, and technological advancements serving as key factors in this evolution.